Okay, welcome. It's July 10th, 2019. It's a little after 7 p.m. Eastern Daylight Time, and I am a member that goes by Gas. We're going to talk tonight about futures, primarily motivated to put a show together because of the new product that came out, the micros. So we've had the minis, and then now we have the micros. So got me thinking about some options, and I'm hoping to cover that tonight. I'll try and gear this towards people that may not be too familiar with futures, and I apologize for those that are experts. And then I'm going to advance to certain points, and then I'll go ahead and apologize for those that this may be all brand new to. But anyways, here we go. Let's talk a little bit about the history of futures. Futures date way back into the 1800s. They were primarily for commodities. Corn in particular was the first forward contract. People that needed corn could hedge against future price increases. And then literally almost 80 years later, the pit was formed, which is the open outcry, what was called the trading floor. That's where the guys wore the jackets with the cow patterns on them and all kinds of crazy stuff to stand out. And they started trading in 1982. On the first day, they almost 4,000 contracts. And then roughly 15 years later, the CME introduced the E-mini futures contract. And that first day, 7,500 contracts were traded, and you'll contrast that to today's volumes. Anyways, the E in E-mini means all electronic, and as the slide shows, the NASDAQ was added in 1999, and then, oh wow, look at that misprint. In 2001, the Russell 2000, and then finally the Dow in 2002. But our new products, the micros, started trading on May 5th, which was a Sunday evening at 6 p.m., which is when the futures sessions start. And that was considered a trade date of May 6th. And they released 4 products at the same time: the S&P, the NASDAQ 100, the Russell 2000, the small caps, and then of course the Dow. And to put things into perspective, I have this chart that shows just what these contracts represent. The farthest leftmost bar is what was the standard S&P contract. That was what was traded on the floor. You controlled roughly $700,000 worth of stock, and your margin requirements were $30,000 per contract. And then once the E-mini came out, it was roughly 1/5 of that. So you controlled a little over $120,000 worth of stock. I'm sorry, $140,000 worth of stock, but your margin requirements are roughly $6,000. And then the NASDAQ 100 came out, and you can see by the chart, I won't go read every line to you, but that, at the time that was roughly in line with the S&P. And you can see gold futures compared to just copper's, oil, soybean. And you can see Bitcoin way down to the right, and that is got a huge margin requirement, as you can see by the it's something like 70 or 80% of the actual contract price. Have you gone full screen, sell some, and Tempest? I can go ahead and enlarge certain portions of the chart, so maybe that'll help you. I will have to sort of scroll around, so I'll review this. Basically, you can see the nominal size, which is how much equity the different contracts. This is a single contract, how much it controls, all the way down to the. It says proposed for all those micros. This was put together prior to the May 6th rollout, but you can see that you control a much smaller portion of equity, which by design that's how it works. And then you can compare. You can see the big drop from what was the S&P contracts. They came up with a mini, which was roughly 1/5 the size, and then you had all that I listed, and then the micros are also very small. We're talking about, this is the S&P, $660 in margin, and you're controlling roughly $14,000 worth of underlying product. So, what are the advantages of trading micros? Yeah, they're 1/10 the size, and what people tend to do is they start trading with an account that's of medium size, let's say $10,000, but they're trading the minis, and they can get into trouble very quickly and basically blow up their account, particularly if they're not extremely experienced and nimble. So the micros were designed to let people with smaller accounts trade and have some room to allow their strategies to work without having to sweat each and every tick. And it's really I think, a blessing, particularly for smaller traders. And what I mean by smaller traders is to really properly trade the what we call the older contract, the minis. You really need an account at $25,000 or $35,000. Really, if you're trading minis and accounts smaller than that, you're really taking on a lot of risk. And in futures, you have certain margin requirements. However, during the day, which means anything before 4:15 p.m., it starts at 6 p.m. the previous night, you get 4-to-1 leverage on that. So actually, you can trade 4 times your account size, and that's an agreement between you and your broker. So the big advantage, in my opinion, is that a lot of people start off trading futures by sim trading. Well, in my opinion, sim trading is really for learning your platform. It's not to learn how to trade. And I have a couple of sim accounts. I have a futures account with 30 million in it, a forex account with 34 million, and an equity account with roughly 890 million in it. So, whoopee, right? What does that do for me? Well, first of all, sim accounts, they have a tendency to give you easier fills, and of course there's no margin department, so you can ride out positions that normally your broker wouldn't allow you to run out. So basically, to reiterate, you're spending, you're basically playing video games if you're sim trading for very long. And as a rule of thumb, I would say you should be able to learn your platform and how to properly place orders and even some more complex orders within about 4 weeks. Now, this is assuming you're full-time at your platform. If you're working and learning, it may be a longer period, but you shouldn't be sim trading for a year or two. I mean, it's really ridiculous. There's no point in it. The idea here is to trade real money and experience what it means to trade with the true emotion of having actual dollars on the table. So let me feel free to ask any questions, and I'll plug along. I'm monitoring the chat room as we go. Hopefully John has some music playing for you. As I see it tongue-in-cheek there, he says at least the audio is good. Am I doing better with the by using the enlarger to show the video? All right, so let's talk a little bit about the products. See, it's funny, on my end it's clear as a bell, obviously. Um, there is some limitation, obviously, with rebroadcasting, and I ran into that in some other previous shows, but I'll push on. So this is a little screenshot of what TradeStation had out. That's my broker, obviously, and they talk about the commissions being about 30% of the standard size futures. Um, there is a couple more screens I'm going to go through kind of fast, and I just wanted to get them on the tape so that if somebody wanted to stop it and review it carefully. But the bottom line is you're trading, in essence, what's 1/10 the size of the minis and the micros, but your overall cost is 2 to 3 times that of the bigger contract. The reason there's a range is you have certain fixed costs, some exchange fees that are fixed regardless of how much of a profit you take. So obviously the bigger your profits per trade, the lower your overall commissions are. But I will tell you this, there's no question if you're having difficulty making money in futures, commissions aren't your problem. Your problem is the trades themselves. So overall, this is extremely cheap, and what a great time to be a trader. You could be at home, you have unlimited access to data, you can trade for virtually pennies, and used to be you'd have to pick up the phone and hope your broker would answer, and then you'd be paying $100 to get in and out of an equity trade. This is going back to when I was a young person, and let me go ahead and push through these next few slides. It's a little data intensive, but basically you're looking at, with the E-minis, you're looking at 50 cents per side. And they do have what they call a tiered plan. So basically, looking up at the $1.50 per side, that's for the minis, not the micros. So you're trading $3 plus the fixed fees. However, when you get into the minis, you're looking at half a dollar. So it's basically $1 per round trip plus the fixed costs. You can get that down a little bit further, down to 40 or 35 cents if you trade higher volumes. I'd say most of the traders in here trade probably less than 300 contracts a month. And at 300 contracts a month with 20 trading days, you're talking about 15 round trips a day. That's a pretty active portfolio. So you're really going to be, if you're an active day trader in futures, you might want to go to the tiered plan. And there's a little, if you go to the TradeStation website, there's a little 2 you can click on, and it goes into further detail. And unless you keep 100,000 in your account, which I kind of laughed, but I got to the rest of it, or make 10 round-term futures contracts in the preceding month, so that's pretty easy to hit. The only thing is that they do charge you a 10-cent per contract overnight fee, and by overnight what they mean is if you carry it through the 5 p.m. Time period. Just to talk basics, futures trade from 6 p.m. on through to 4:15 p.m. Then there's a 15-minute lull. Then there's what they created, I don't know, about 2 or 3 years ago. I call it the margin department half hour, where they, from 4:30 to 5, they clean up their books, and that allows the margin department not to be in panic mode closing out accounts, because they used to have to try and do it between 4 and 4:15. The only caveat for this is when you have a holiday session like we had over the 4th, there may or may not be a period. On the first, the Wednesday, they had a period from, the markets closed at 1 p.m., but there was a 1:15 end of trade time. So it was really 1:15. You had to be within your margin requirements. In other words, you lose that day trading 4 times factor. But on the Friday, they cut it off at 1 o'clock. There was no period, so you had to actually be within your margin requirements right at 1 p.m. or you were dead. And actually approaching that, and I called the margin department just to ask about how they were handling it. And the guy says, "I'm the only guy here." And I said, "Well, okay, transfer." It was a trade desk. I said, "Transfer to the margin department." He goes, "They're all at home." So these guys that ran the margin department on the Friday, the July 5th, were actually at home, closing out people's positions. I guess they're set up to do that through their home-based computers. It keeps the labor costs down. Can't blame them. So, to review, basically, just looking at the ES, you're looking at almost 7,000 for the mini contract. The micros are exactly 1/10 of that. Now, you'll see on this slide, there's a initial margin and a maintenance margin. And just for definition, the initial margin is what happens when you initially take the position. If you happen to swing it or carry it past the 5 p.m. deadline into the next session, now you have a slightly reduced margin requirements, and it's going to really apply to people that swing futures contracts. A lot of us will either be flat or carry very few contracts through. We're not institutional investors by and large, I don't think. But basically just keep track of your initial margin. I promise I'll be through some of this sort of data dependent stuff pretty quickly. Basically, this is a spreadsheet showing the margin requirements, and on top we have the standard minis, and the micros are below. The EMD, which is the mid-cap 400, there is no micro for that. So now I've figured out how to use this blow-up deal now, so I have to click it twice. So in any event, you can see the symbols in the first column, what a 0.1% move is. So you're comparing apples to apples. Pogie, if you go full screen, hopefully that's helped some other people. What a point move is in the contract, and it's pretty easy to remember. Basically, the ES and the NQs and the ES and the small caps, the RTY, they're $50 per point. The Nasdaq is 2/5 of that, or 20. The YM is each tick is $5, and then obviously when you look at the point move in the micros below, it's exactly 1/10 of that. And what the dollar amount is for a 0.1% move. So you can see basically that the small caps, for example, they have a much smaller dollar value to a 0.1% move. Hence, the margin requirements are much less. And you can see that over in the right-hand column. Yeah, that's that's because I finally figured out how to use the expander, if you will. Alright, so now that I know how to use this thing, I will try and pull it up high, bring the resolution up by using PowerPoint's magnification tool. This is a calculation that shows what you get per $100 worth of margin. There's a slight efficiency, and this is the ES. It looks to me that the Nasdaq is actually the least advantageous. These differences, however, are probably small compared to your overall profit and loss. So, as I said earlier, if you're having difficulty uh, making money in futures, it's probably not the commission structure that's trapping you. It's probably your entries and exits. But here we have what a tick value is worth, and this is the ES. Now you see that exchange fee, that's the fixed fee, and and the NFA fee, that's fixed. And then there's a clearing fee that should be fixed, and then of course I'm sorry, the commissions that will be fixed per contract, and then so there's an approximate total cost. The reason it says approximate is because depending on how much of a profit you take, those fixed fees become a smaller and smaller portion. So if we look at the ES versus the NQs, this is all minis now, and the YM, it looks like the ES has a certain advantage over the other two. And we can see the same thing in the bigger, the minis. So this one's really thick with information. I just wanted to put it out there for those that are really new to futures. And basically it talks about the mechanics of the futures, the specs, if you will. And I'm just going to highlight this and just slowly spread across it. It's just really for those that are going to go back and look at the video. These new micro contracts do trade on a quarterly cycle, just like the minis do. Same thing there. And then once again, the contract is done at 9:30 Eastern Time on the third Friday of that contract month. So if you're trading the September contract now, on the third Friday at 9:30 a.m., that'll be the end of trading on that contract. And you'll see some wild price swings. Alright, so enough of the technical stuff. Let's talk a little bit about minis versus micros. And I can really show it to you in one single screen, and it really sums it up. This is an actual trade I had on. So I had a missed opportunity here, and I'll explain it here in a second. When I go over to the chart, you'll see it. Basically, this is 1 a.m. I had taken a short, and in a bit I'll go through my whole chart. So we'll cover the elements of my trading charting software in a bit. But basically, I took a short here. When you see a red circle, that's a short. And then I had a profit target set and a stop loss set. Now, it looks pretty narrow compared to what the ultimate price action was. So my point being is that when you trade these big contracts in a smaller account, you don't have the nerve or it's almost reckless to let contracts, who would have thought I would have gotten that kind of a move overnight? But had I been in something that I could stomach, the micros, for example, I could have let that run and been surprised at 7 in the morning or something when I woke up and I was up a pile, as opposed to, okay, yeah, I got my trade. This is why sometimes trading gets to be a bitch. You're happy the minute you get your profit, but then next thing you know, you could have made 2, 3, 4, 5 times that. So if you're in a smaller account, and again, it's under $35,000, $25,000, the micros, let you have some room. And we don't want to get, at least I don't want to get into discussion about how tight stops should be at this point, whether you should have stops. But clearly, it's a lot easier to absorb a 10-point move when you're trading micros than it would be if you were in the minis. So I want to talk a little bit about futures versus other indices or ETFs. Basically, it has to do with cost and margin requirements. It's interesting when you look at the timeline of the actual percentages of what trades. Between 86 and 92, the only game in town was the S&P 500. So I can't show both at once, but basically during this period. And once the some of the other contracts came available, that's what the blue line is. And then finally, in before 1998, the E-minis came up, and that's the red line. And then by the time we got into about 2009, the ES overtook the large contract. And you can imagine we're 8 years down the road, or 9 years down the road from there. And you can imagine where this chart would be now. But the point is that now the floor is closed. It's basically all ES all the time, and there's just huge volumes, and I'll show you that in the next slide. So this is the average daily volume. So we're look at that on the E-mini per day, $220 billion worth trades hands. But you compare that to the underlying ETF, which is the SPY. It's roughly, the ES is roughly 9 times what trades the SPY. So you can see there's huge liquidity and huge interest in trading the futures versus the ETF, in this case the SPY. And when you go back and look at the E-mini compared to all 7,000 ETFs globally, we're still at that 22 billion. All those 7,000 ETFs still aren't even half of what the ES does. And looking at the NASDAQ 100 versus the QQQ, it's roughly, the futures contract is roughly 10 times what's traded in the QQQ. And there's reasons for that, and I'll explain in a minute. And on the Dow side, you're looking at almost 30 times the volume in the futures contract. And the E-mini, it's about 3 times, so not quite as much of a spread in the E-mini. So the IWM, which is, a lot of us know is the Russell 2000 ETF. So there's still some decent volume in that compared to the RTY or the futures contract. So there's certain advantages to futures, and I'm going to point out there's a lot of information on this slide. I'll just scan through it for those that are going to watch it at a later time. Basically, we're looking at the ES versus the SPY. So with the ES Mini versus the SPY, we're looking at $5. This is what they call a contract multiplier. And then the nominal value, which in essence is 14,000 for the ES Mini, but obviously the SPY you're buying like you would an equity. It's roughly 280 or so, at least the time when this slide was put together. Now, round-the-clock trading, do you have it with the SPY? No, you don't. So there is a certain advantage to trading futures for that reason alone. And what people don't realize is that when you buy the SPY, there are management fees in that thing. However, in futures there are none. It's a small percentage, but it is there. Now the margin obviously is going to be hugely different. For the ETF, it's roughly 50%, but 4% for the futures contract. Also, and I'm going to get into it later, which is it's pretty exciting for me because I didn't know about it until I put together the talk. But the margin efficiencies for spreading is true with futures, but not available for the SPY unless obviously you're using spreads and options. And then the other thing that's important is the tax advantage. In futures trading, your capital gains are reported as a 60-40 rule. So it's, I believe it's 60 short, 40 long. Any gains in the SPY would be considered ordinary income. And to see that effect on a tax return, I'm going to look at two traders. Idaho Home Info. Can you not read what's on the chart now? Go full screen if you haven't already. But if you look at Trader A that makes $1,000 in the E-minis versus Trader B who makes $1,000 trading the SPYs, I had it backwards. So 60% is considered long-term capital gains, limited by law currently at 15%. Obviously that could change. But 40% is taxed at ordinary income. Trader B, however, has to pay the higher short-term rate on 100% of his gains. So what ends up happening is Trader A pays $218 in taxes on that gain, where Trader B pays more, almost $100 more. It doesn't seem like much when you look at one trade, but if you make multiple trades, it certainly would be advantageous, obviously. And that differential actually goes up for those in higher income brackets, 35 or 37%. So, big difference. Now, it's interesting. This slide really has a ton of information in it. It just talks about who's trading the E-minis. Obviously, there isn't enough history with the micros to say who's trading that. However, let's take a look at that a little closer. So, the number of trades broken out, obviously totaling 100%. 33% or 34% of the volume is the high-frequency trader. That's the computer, obviously. Then there's market makers. Then there's swing position traders, and look way down at the top, the amateur traders, 1%. So it's kind of a myth that the computers are stealing from retail, because retail really doesn't amount to a high volume. But if you look at the number of traders, there's obviously a huge number of amateur traders in there versus the number of high-frequency traders. But it was said during one of the webinars I sat through for everybody's saving of time. So here at Day Trading Radio, I sit through the webinar so you don't have to. But at one point, it was estimated that the high-frequency trading accounted up to 2/3 of the volume in the equities market, whereby it's only 1/3 in the futures market. Now this I found to be the most instructive. When you look at the high-frequency traders, they're trading 100% limit orders, 100%, as well as the market makers. So they're not getting any slippage. And for those that don't know what slippage means, is that when you have a stop market order, it may trigger, and I'm going to talk a little bit more about triggers, but you may or may not get filled at your stop price. It may get filled well below that if you're in long, or well above it if you're in a short. And that was predicted with the new micros, that there would be horrendous slippage, and I actually found that to be the case watching them trade. But if you look, the amateur traders, they're only getting roughly 70% of their trades in as limit orders, and that, folks, is really the key to having a successful, in my opinion, trading plan, is to try and get your orders to fill as limits. That's really key. And to just show you, for those that aren't familiar with this, this is what TradeStation calls the matrix. So speaking of algos, you can see on this where the algos are living, and I'll show you how that looks on the matrix. It's called DOM in some of the platforms, but you can see here, just looking at the bid side, which is in the blue, you'll see these numbers that are all very similar. You can't tell me that's retail or human beings placing those orders. Those are computers having a certain level, what they want to get at. But then there's a gap where you see 1, 2, 3, 4, 5, 6, 7 ticks where there's small amounts in the bid and ask column. That's retail. Then you can see above the same thing again. You see these large orders of very consistent, and then you'll see in a live matrix or DOM, you'll see those jump around considerably. And at first, when I investigated the micros, I thought, well, all they do is get 10 people together and agree to buy or sell a contract. Well, no, it's truly a contract that's separate in and of itself. It has to be. That was a dumb thought on my part. But the contract definitely is really something that the algos would probably love to play in, particularly if there's going to be smaller, less experienced traders in there. They're going to get the stops hit, and it's when the stops hit and you get a bad fill, that's where the high frequency traders and the market makers make their money, on your bad fills. So let me stop for a second. Any questions at this point? I don't know if John has music playing or not. Anybody still awake? All right, John, I'll continue. So now let's talk a little bit about the equities, and particularly the FANGs versus the QQQ versus the mini NASDAQ. So you can look at Facebook, Amazon, Netflix, and Google. You can see how many shares trade, what the average volume is. The key here is to look at the margin required. So to trade an equal amount of the four FANG stocks, you need almost 40,000 per entity. Obviously, you're limited to no 24-hour trading, and there's no advantage to the tax. Now, when you look at the QQQs, to trade an equal amount, you'd need to have roughly 76,000 in margin. Now, there is some diversification because you have 100 issues in the QQQs. Magoo, I'll get to your question in a second. I think I know your question, but if you look at all FANGs, you know, you're looking at even with a margin, once again, 72,000. But now let's go over to the far right and look at the E-mini contracts. Again, this is not micros because there's just no historical data yet. And that's a point that was made in some of the webinars, is that you can trade the micros, but do your research on the minis. In other words, the price action is going to be very similar, but there's no, obviously, since it's just started trading a couple months ago, there's not a good historical base to go back and do required studies. But look at this margin requirement, $7,600, and you still have the diversification because it's the underlying issues include 100. So my point being is that in futures you can play the fangs for a hell of a lot less money. Now here's a concept that I find to be extremely interesting. Oh yes, Goo, you mentioned lifting orders. If you're talking about orders being canceled, two things about that. One, um, they play games before markets open often. They'll place orders down to think there's pressure on the stock or the contract in this case, and they'll be pulled seconds before the open. And they do it to try and fool the retail investor. So I don't pay a whole lot of attention to where bids and asks are prior to the actual open. Now, in order to for the algos to operate properly, they have certain, I would assume, limits to how many shares they want to have open, and they're not going to, if they like a higher level to short, let's say, they're not going to leave the lower level there as a ask. They're going to cancel that order and move it up. And when you watch the Dom and the Matrix live, you'll see that those jump all over the damn place. As a matter of fact, when the micro market is thin, which, evening time, sometimes you'll see a trade way outside of the bid and ask spread. And that's why you have to be careful on your stop orders. And I'll cover that in more detail. So margin offsets. This is already 40 minutes in. When you look at your margin requirements, we covered obviously the initial margin requirements, but there's an unusual thing in very similar products. You can be long in ES, for example, but short in the NQ, and it actually reduces the amount of margin that's required. And in this example, we have two of the Russell 2000, so the small caps, and one of the micros. And if they're in the opposite direction, then you can have, instead of having to have 1,442 in equity there to cover your margin requirements, there's a margin offset of 80%. So now you need under $300 in capital to continue those trades. Let me make sure I didn't blow that up enough for you guys. So you can see, instead of having, literally it's a huge reduction in what you have to have on hand, which actually gave me a trading idea, and I'll talk about that at the end of this section. But you can see that difference there. And this is with the minis, so if we're talking about micros, you could divide that by 10. So it really gets to be, you can use a spread, what they call a future spread, or a span, and that would save you a ton of margin requirement. May not be the best strategy, but in any event, looking at using, in this case, E-mini spreads, again, the savings would be similar for the micros. But if you think the small caps are going to do better than the large caps, you would go long the Russell and short the S&P. Because of the size difference in the contract, you'd go long two of the Russells and short one of the minis, and you get an 80% savings in your margin requirements. Also, the next scenario is you think the blue chips are going to do better than the large caps. Well, again, you go long one Dow and short one S&P, you get a 75% reduction. And the CME will change these ratios periodically, and I'll get to that in a second. But if you think the small caps are going to outperform, but the blue chips, as opposed to the large caps, you'd still be long the two of the micros, excuse me, of the mini Russells. But instead of shorting the S&P, you short the Dow. In that particular case, it's a 70% reduction. And that's set by the CME. And what TradeStation's margin desk told me today when I called them to verify is that they follow the CME's recommendation as far as margin offset requirements. Yeah, remind me if I forget to use the enlargement tool. So those are three scenarios, and obviously that can be, there's a lot of variety of that depending on which area you think is going to move. And for those home gamers, you can actually go to the CME website and they can give you a downloadable application that you can run on your desktop and set up your portfolio and even a potential portfolio. And it's a long process, at least if I was to try to explain the whole thing. But what I did, and I think is best to do, is just call them directly, and I have the phone number there for you. So there's a website. The keywords is CME Core. And then the best thing to do, honestly, is to just call them in Chicago and get them to walk it through you. But what you end up doing is setting up a portfolio. In this particular case, I'm long two of the Russell minis, and my offset is short one of the ES micros. So M2K is micro and MES is a micro. So basically, one little trick, both these things have to be checked. The contract with positions and all positions selected need to be checked to get your portfolio to run properly. Then what happens is there's a little plus minus button on the top of the application, and it then calculates what your margin requirements are. They call it a span risk. So your initial requirements for that, having 3 contracts on, is only $295. So really, I think this is great. I mean, if you're running into a situation where you're approaching the close, or even you're mid-afternoon, and you're in a couple, you're in one position that's not working out just right, but you don't want to take the loss, you can actually put a hedge on by shorting another product. It's in that same class, and I say class, I mean we're talking about the 4 horsemen, right? The Dow, the NASDAQ, the ES, or the small caps. And you can actually get your margin requirements greatly reduced. As that previous screen showed, it was anywhere from 70 to 80%. I think that's fantastic, and it really gives you some options. No pun intended. So looking at the different contracts, and I do this live on my platform, and I use I have a workspace. I just call it Futures Compare, and I can tell from the feedback from the viewers tonight, there's no way I can show my platform without it being way too blurry. So I'm just going to use these screenshots, and what I've set up here is what they call radar screen, and There's the 8 o'clock bell. So we have the current contracts, and there's an indicator called description, and I have that there. Obviously, once you get used to the symbols, you won't need those. And I have the current contract, the current micros. So these are all September contracts. Then I also have the out contract, and then the out micros. So I have those running live during the day. For some reason, I'm not getting any data on the December mid caps, but I don't trade them, so they're also pricey. Obviously, you have your usual quotes and percent change. This column here, the percent move, and unfortunately I can't show too much without it getting too blurry. But what I did was I wrote a very simple indicator just saying what point move would be a 0.1% move in the stock. And when we're looking at this, I'll move over here. So in the NASDAQ, you're looking at about 8 points. The ES about 3 points. And we know what those are worth. The small cap, keep in mind the small cap and the ES run the same tick value, but obviously the small caps return about half because the margin requirements are half. Then you have the Dow, you're looking at about 25 points. Now what's really interesting is when you look at the volume, don't forget the micros are down here, the minis are up here. There's still much greater volume in the minis. However, I'm seeing the micros start to pick up. And when we have open interest, that means how many contracts are currently out there. And with one contract out there, there's somebody that is long and short at the same time. That's what means. There's a buyer and a seller in there. But the open contract, and what's interesting, if you look at these issues and what percent of the open interest is traded. The lowest is the Russell 2000, so it's more of an investment vehicle. And I see that on the charts. It tends to be more linear. If you catch it right, it can be fantastic. But what trades the most? You got the Dow's trading high. You have the NASDAQ as well. So they're trading in the mini. You're trading over the open interest and then some. But when we go down to the micros, look at these numbers. And by the way, don't pay too much attention to the color, just the way I wrote it. If it's red, it just means the percent's less than it was the previous session. If it's green, it means it's gone up a little bit. But look at the NASDAQ 100, the micros. 10 times the open interest were traded. This screenshot was taken around 3:30 p.m. You're still seeing huge percent of open interest traded. So these micros are definitely day trading products, and it makes sense. The other thing I do is when we're approaching the rollover dates, I like to look at how much volume is going off in the out contracts versus the near contracts, and it gives me a better idea when to roll over. The other thing I can't show it on this screen but you can double click any of these columns and sort it. Right now this thing is sorted by the net change for the session. So you can see at a glance that the NASDAQ was the winner today, and it went on down the line. The small caps and the Dow were the laggards. The ES was sort of in the middle. But this could be helpful if you're looking at trading more than one product at the same time. In other words, you might want to be long what's moving and short what's not moving. Of course, that can change at a moment's notice. And this other part of the screen, it just lets me look back four sessions and seen what the change has been, and you can see that over the last four sessions we haven't really gone anywhere. Doesn't mean there wasn't movement within there, but we really haven't gone anywhere. Okay, before I get into the next section, how are we doing? Any questions? All right, let me cover just my screen set up quickly, and then so when you look at the next section, then we'll take a little intermission and go on to part two. So this is an actual chart. It's the micro Russell. I just want to show you the parts of my screen so you know what you're looking at. There was a long entry that's off the screen to the left. This white line is a manually moved horizontal line that has a built-in alert so that the price moves above it. In this case, or below it, I get a certain sound to let me know the price has dropped. And that's good for if you're not watching a particular chart and there's price movement. The purple line on top is the opposite of that. It's a line above to let me know that the price has moved up, and I move those lines around manually. As far as indicators, I use a high-low indicator. I covered it extensively in other talks, but basically it's the lowest low looking back a certain number of bars, and it's a dashed line. It's green. The reason it's green is if you were counter trending, it'd be a place for you to get long. There's also a red line. It's dashed. That's the highest high looking back a certain number of bars. That would be a place where you tend to want to short or get out of a trade. And I did put a midpoint line in there, which is white. So in this particular case, I had a long, and we're talking from the evening time. It may have even been a swing, I don't remember. In any event, when we got into the open, I was obviously in the red, so I ended up adding on a little bit of a chase right at the open. You can see the volume increased. The Stokes had turned up, so I added 2 there, so that's why there's a little number 3 there. So what it's done is taken my original 1 car, I've added 2, so now I have 3. Then I added 2 more, then I'm total 5 contracts long. And ultimately, as the day goes on, I have 2 other indicators on here that I want to talk about. One, I use the yellow linear regression line, and I use that from the session start. This is on a 5-minute chart. So that gives me an idea of the overall trend for the session. Then I carry one through last session, including the data from this session, to give me some idea what the 2-day trend looks like. You can see sometime around 7:30 before the market opened, the new session started to show an upward bias compared to the 2-day trend, if you will. And I find these linear regression lines to be places where the stock price can get stretched away from that, and that's a good place for it to snap back. In any event, these white dashed lines are the legs, the winning legs, and whenever happened, this is towards the close, 6 p.m. Ended up getting a limit order filled, and that must have been for, I think, probably 3 contracts. That left me 2, and then as we got right to the actual equity close into the extended part, the little 15-minute extended futures, I had a stop and a profit target, and ultimately the stop hit 1 tick below where I'd gotten out earlier. So I went from having 5 contracts to now having one contract. And you can see the little one up there. And this blue line is a stop market order that eventually it cuts off because it got canceled when I had filled up in here. So that's an actual, that's my chart. And hopefully when we go to the other screens it'll make more sense for you. These were just screenshots of the corners of that, so it's before I learned how to move stuff around. So again, here's my chart without all the annotations. And again, it's pretty simple. I have this high-low indicator. I have my linear regression lines. And of course I have my bars. And again, this is what it looks like without all the crap I put on it for the talk tonight. So that's my pretty simple setup, I think. The other thing I have is I call a fixed futures chart, and I'll show that now. And what I like about this is that it's a specialized chart. What happens in most platforms is it's auto-scaled, so that if there's huge price movements, it gets shrunk down to fit your rectangle, if you will. But in essence, you're not really sensing how much you're getting in movement. So what I have created is a fixed percent chart. I'll show you the settings in a second. And here we're looking at the open on the NASDAQ. This is the mini. But you can see that between 8:30 and 9:30 there was a huge movement upward. So when you look at the settings on this, and it's under scaling, the upper limit of my rectangle, if you will, is 0.25% above and 2.5% below. So the whole screen, if you will, the vertical distance represents 0.5% in price movement. And you can see that prior to the open, I guess we might have had good news at 8, I can't remember now, but in any event, all these prices moved into what I call uncharted territory. And it helps me get an idea of how rapidly the stocks are moving. And I have them on 5-minute charts, and they're really good to watch, I think. And then I put it on 20 just to get more perspective. And you can see there's a little bump up, around I don't know, 9 p.m. But then it fell obviously below this, and then it zoomed up. There must have been some good news at 8. I can't remember what day it was that I shot this, but it may have been the jobs data. So let me wrap up showing I also have a screen where I use my 60 minutes, and this really is my go-to screen for looking at overall trends. The way I have it set up is I have 60-minute charts, and on the chart I have my highest high and lowest low lines. You can see them here: red, the midline white, the lower green. And then I have a MACD gradient paint bar indicator, which means these bars will change color depending on how rapidly they're moving. So the closer it gets to deep purple, the more it's dropping and with velocity, and the more yellow it gets. And trust me, it's a lot brighter at my end than what you're getting through this reproduction. But it's a nice way to see the movement, not only spatially but also with the colorization. So, and that's out there available for anybody to download off the forums in the TradeStation forums. So I have the dollar, the NQ, the ES, and for those that aren't familiar, there's the actual contracts have their own symbols, but then there's also what they call a continuous contract, and it starts with the ampersand, so it's ampersand NQ, and you can go back and look at months and years worth of data on the NQ without having to change the different symbols. So it's good for strategy backtesting if you're into that sort of thing. And then I have the ES and the small cap. Also on this chart I have obviously volume, and you can see the spikes when the normal sessions and then overnight sessions much slower. I also keep on this chart what they call a $ vol spread, which is a total S&P volume, and it's also based on price movement. So I have alert set at 100,000 and I think 200,000. So when this thing breaches that, it's a bullish sign. When it goes below the minus 100,000, that's negative, and that also has an audio alert set up in it. And lastly, one of the other screens I watch pretty closely is what I call my 1-minute charts. So these are 1-minute charts. I have also tick and vol spread on there. And basically this is the DOM of the matrix. In this case I have the micro ES, which I'm not in a trade. I do have one long at the time I took this with the micro small caps, and those are linked through the linking buttons to charts. So here's the ES, here's the small caps, and you can see there's an order line there. I also have a third chart that's smaller that I could substitute these if I switch to trading the NQs. I can move those up, and obviously I can change it to whatever I want. Lastly, here's my tick chart. I have 2 levels of alerts, plus 600, plus 800, as well as minus 600, minus 800. And then lastly, something I used to just beat the drum about, I have vol spread, which is the S&P, and looks at not only volume but volume times price. And I made a big deal about following this during the day to get an idea when you're seeing trending. But I noticed one thing, and it's really unfortunate for us retailers, but there's been a trend in the brokerages, and that is they developed the ability to trade off tape. And what they do is they will make trades between themselves for massive blocks of shares, contracts. It's true also in equities. So what ends up happening is on a daily basis, you'll see these large tails. This is a 15-minute chart. You'll see these very large tails at the end of the day, representing, in some cases, half the volume and movement for the day. But obviously, the last 15-minute bar of the session is going to help us retailers. This used to be a much better indicator, but you see these huge tails. I think this is a product of the fact that there's so much off-tape volume now. What the SEC requires is that if there's an off-tape trade, there was a private transaction, it needs to be reported, but only by the close. So that's why you see these massive spikes in this vol spread at the end of the day. These trades, this movement really took place earlier in the session. We're just not seeing it as retailers. I think it gives them a huge advantage because they know where the big money's moving because they're doing it. So I kind of moved away from any volume indicators anymore. I think they're becoming less and less valuable just because of what's happening in the commercial end of trading. So here we are, just over a little bit over an hour. It's a good time for a break. Just to review, it looks like the ES is moving up a little bit. Let me open up. Anyways, let me take a break here. Give you guys a chance to refresh your beverages and or whatever you want to do. And I'll be back in 10 minutes or so, and I'm going to cover the next subject, which is going to be the multi-car strategies. I think it's something that will probably be helpful to those that have been stuck in the one-car nightmare land. All right, I'm going to stop this recording. And Jesus, Magoo, you can't see that? Anyways, I'm going to stop broadcasting for a minute, and then I'm going to re-establish the broadcast. And please, when I get back, remind me to record. Magoo, you can't read that? I mean, it's pretty, there's not much there, a few words. I don't know what to say. Yeah, I'm trying to get over that hump by using the magnifier. If you haven't gone full screen with the DTS primary video, I recommend that. Um, I don't know much more to do except invite you all over to my house and let you look over my shoulder. Isn't Magoo the guy that couldn't never see the cartoon character? Anyways, I'm going to stop this recording. I'll continue to show this, but I'm going to go ahead and be back in about 10 minutes. Give me a break.